Right. Good morning, everyone, and welcome again to ETF Festival 2024. So my name is 𝗪𝘃, and I'm with the research team at FSM. So earlier today, 𝗪𝘆𝘀 shared about the new ETF focus list, some of the changes that we have made, new ETFs, new categories that we have introduced, so on and so forth. So today, I'm here to share about a sector that has been on our focus list since the first iteration came out back in 2019. And it also happens to be one of my favorite investment ideas. And yes, as you can see on the title, it is none other than semiconductors. But before I begin, just a quick show of hands. How many of you here have heard us talk about semiconductors before? Put your hands up. Okay, quite a few. But I think majority of you have not. So I think this will be a good time to learn something about this industry, and hopefully you can go back with some new knowledge today. So without further ado, let's get started with a recap of how the market has been performing in terms of share prices. So if you can see from this chart over here, you can see that 2024 has actually been quite a good year for semiconductor stocks, which is demarcated by the blue line. So share prices for semiconductor companies, they rose by about 30% on aggregate, which is measured by the VanEck Semiconductor ETF, which again is our recommended ETF for this sector, but more on that later. But in contrast, if you look at the orange line, which is the broader market gauged by the S&P 500 index, it only gained about 9.5%. So the performance of semiconductors is actually 3 times better than S&P 500 in the first 4 months of this year. Okay, 30% in 4 months, it is a significant gain. So this sharp rally in chipmakers, it may be attributed to several factors, such as the AI frenzy, which has of course taken the market by storm. So these days, everyone is either talking about harnessing AI, building AI, or investing in AI, which of course benefits your semiconductor companies because they are the ones that make the chips that goes into all these AI systems. So second reason is that growing investor optimism following stronger than expected US economic data, and also the growing possibility of a soft landing has also added to the rally in chip stocks. So the last reason that I can think of, which is also the most important reason, is that many investors, they are starting to realize the potential of this industry and are thus starting to price in higher earnings for semiconductor companies, which effectively drive share prices up. So if you take a look at this chart over here, you can see that the sector's earnings, they are expected to rise by about 30% on average over the next 3 years. So this is significant, considering that its historical compound annual growth rate over the past 10 years is only around 17%. And if you take a look at the S&P 500 index, the average earnings growth over the past 10 years, it is only around 8%. Now, you may have noticed that in the post-COVID years, namely 2022 and 2023, growth in terms of earnings, it was rather weak, and that was because the sector was actually going through a downturn, which led to lower sales and hence earnings. So this chart here, it plots the semiconductor industry's year-on-year sales growth. So you can see very clearly the cyclical nature of the semiconductor industry. And you can see that sales growth was actually negative throughout most of 2023, and at one point it actually fell by about 20% year-on-year. So you may recall that back then, many companies, they were warning of a supply glut and they were actively cutting back on capex. So memory makers in particular, they were heavily affected with some of the major companies like Micron and 𝗂𝘃𝗁𝘃, for instance. They reported several quarters of negative earnings as they cut prices in a bid to clear off excess inventory. However, if you look at where we are today, you can see that we are currently in the early stages of a new upcycle. And as of the first quarter of this year, semiconductor sales have actually risen by 15% year-on-year, which is a significant jump from the 5% gain from the last quarter of last year. So going forward, we think that sales growth for this industry, it has the potential to exceed 35% in the coming years as the AI megatrend continues to unfold. So on that note, we believe that the semiconductor industry, it is once again at a pivotal turning point thanks to the rapid adoption of AI, which requires not only your highly advanced processors that are capable of handling these huge workloads efficiently. And just like previous revolutions, such as the PC, as well as the mobile revolution, we do believe that the AI revolution will bring a lot of opportunities for semiconductor companies. And now, if we take a look at some of the bottom-up earnings data, we can also see that the cycle is starting to turn already. So if you pay attention to the chart on the left first, you can see that TSMC, which is the bellwether for the semiconductor industry, it saw its earnings grow by 9% year-on-year in the first quarter of this year, which exceeded analyst estimates. More importantly, TSMC has also said that revenues for the month of April, they actually grew by 60% year on year, and that was largely helped by AI chip demand as well as a recovery in consumer electronics. And if you look to the chart on the right, besides TSMC, another company that has been doing well on the earnings front is, of course, NVIDIA, which is probably the company that comes to mind when everyone talks about AI chips. So last year, NVIDIA actually more than doubled its revenue from 27 billion in 2022 to around 61 billion in 2023. And that is primarily driven by its data center segment. So the data center segment is actually denoted by the dark blue bars in the chart over here. And as you can see, NVIDIA's data center segment, it was practically non-existent 10 years ago. But today, it contributes roughly 80% of the company's revenue. So of course, earnings for the company, it did not disappoint either, as they rose by nearly sixfold from a year ago to a record high in 2023. So with such earnings growth from chip giants like TSMC and NVIDIA, I think it's no wonder that investors, they are starting to believe that this AI revolution is not just some passing fad, but instead one of the biggest structural megatrends that we are going to see in the 21st century. Now, moving on, our conviction in AI, it is also strengthened by the fact that some of the largest tech companies in the world, they recently announced plans to ramp up their investments in AI. Many of them have actually already invested billions of dollars, and they are still willing to spend even more money to build up the necessary infrastructure as they recognize the value that AI brings. So for instance, Microsoft recently said that they expect capital spending to increase materially, driven by investments in cloud and AI infrastructure. And if you've been reading the news over the past few weeks, the company has also said that it intends to spend billions of dollars to advance its cloud initiatives in places like France, Malaysia, and even Indonesia. So the company has also surpassed expectations in its latest quarterly results, where its revenue for cloud services climbed by about 30% year over year, attributing around 1/4 of that growth to its AI services. So meanwhile, if you look at another major cloud service provider, which is Google Cloud, it saw its revenue grew by about 28% year on year, while its operating income actually quadrupled to nearly $900 million after years of heavy investment into this segment is starting to pay off. So similarly, the company also expects capex to pick up, driven by investments into AI. And if you look at the chart on the right, collectively, the big three cloud service providers, which are your Amazon, Microsoft, and Google, they are expected to spend in excess of $116 billion on capex this year, which is a 22% increase from last year. And again, this is good news for the semiconductor sector. So one thing I'd like to point out is also the fact that many of these AI chips, they are very expensive and they cost significantly more compared to your regular chips that goes into your phones, your computers, and even also more expensive than chips that are used for your traditional data center purposes. And because of how expensive these chips are, it should be a major cash cow for chip makers going forward. So there's a saying back in the gold rush that goes something along the lines of, in a gold rush, you want to be selling shovels. So if we extend the thinking to today, then we should be in this AI rush. The companies that actually benefit from this AI rush are the companies that actually produce the tools that make AI possible, which are your semiconductor companies. Now, enough about AI. So aside from AI, there's also another sector that is also expected to boost the growth of this industry in the coming decade, and that is none other than automotives. So according to an industry survey conducted by KPMG among some of the senior executives across global semiconductor companies, automotives is actually the second most important growth segment over the next couple of years. So as of late, many of your automotive chip makers, such as the likes of NXP and Infineon, they are starting to turn more positive on this segment as the auto industry is also becoming increasingly digitalized. So in addition, with global electric vehicle sales set to skyrocket in the coming years, as more countries, they continue to pursue their environmental goals, we think that opportunities in this space, there are plenty as well. So while a traditional internal combustion engine vehicle or petrol vehicle will typically have around 300 to maybe 1,500 chips, a new electric vehicle has easily twice that number. And those with self-driving capabilities, they definitely require more chips given the sheer numbers of cameras and sensors that these cars employ. So according to estimates by Infineon and Tech Insights, the cost of semiconductors in a petrol car today, it is roughly $750. Comparatively, the cost of semiconductors in the electric vehicle is roughly double that amount at around $1,300. And if we project further into 2030, you can see that the cost of semis in a car will actually reach $2,000, which is a good 50-60% increase from today. And that, again, is a huge opportunity for chip makers to capitalize on. So more generally speaking, as the world becomes increasingly digitalized, the silicon content in all electronics will continue to trend upwards as well. And according to a study that was conducted by IC Insights, the value of semiconductors in electronics today has risen from roughly below 20% at the beginning of the century all the way to more than 31% today. And it is projected to continue climbing as the world becomes increasingly tech-driven. So just look at the number of smart devices that we have today, and I think you'll see my point. So these days, we not only have things like your smartphones, smart cars, watches, but every electronic device has the potential to be smart, including things like your refrigerator or even your coffee machine. But to achieve this kind of level of connectivity and technological advancements, you not only require more semiconductors, but also semiconductors that are advanced enough to accomplish these things. So the bottom line here is this. As the world becomes increasingly tech-driven, we think that chip demand, it will become even stronger than before, and that should lead to more opportunities for chip makers and consequently benefit the entire semiconductor industry. So aside from these factors, the massive amount of government support that this industry receives is also another crucial factor behind its growth. So across the world, you see news that governments are handing out massive amounts of incentives to build fabs, adding to the total supply of semiconductors in the years to come. So over in the US, of course, you have the $280 billion Chips and Science Act, which is designed to boost American semiconductor R&D as well as manufacturing. And if you look across the Atlantic Ocean to the European Union, they also have something similar. They also have their own Chips Act, which plans to increase their share of manufacturing capacity and also to boost its technological leadership. And if you look over to Asia, China, of course, is throwing billions of dollars into this industry to catch up after years of sanctions by the US and as well as its Western allies has basically crippled its semiconductor industry. And last but not least, Japan, whose chip makers, they once dominated the industry back in the 70s and the 80s. They are also looking to regain their lost status as a semiconductor powerhouse. So the Japanese government has also launched several initiatives to foster greater collaboration between foreign chip makers as well as its domestic chip makers. So now that we have established a structural case for investing in semiconductors, I'd like to take you guys through the valuations. So as you can see from this chart over here, semiconductor stocks, they are trading at roughly 30 times this year's estimated earnings, which is 2024. And that puts it on the high side relative to its 5-year historical average of around 24 times. But bear in mind that markets are forward-looking. And as investors, we should also be forward-looking as well. There's no point looking at the past, there's no point looking at the present, we only look forward. And if we were to stretch our investment horizon out further, we can see that valuations, they are not as daunting as they are, trading at around 18 times 2026 estimated earnings. And this again is because the sector is expected to deliver earnings growth of close to 30% each year over the next few years. So at FSMOne, we like to focus on earnings because we think that earnings, they are the biggest determinant of share prices in the long run. In the short term, share prices can be driven by investor sentiment, speculation, but in the long run, share prices are driven by earnings. So more often than not, you see companies that are able to deliver sustainable, resilient earnings, they see their share prices rise in tandem. And those that do not tend to see their share prices falter. I think the chart on top clearly illustrates this. So besides earnings, there is also potential for multiples for this industry to expand, which will also mean more upside for investors like you and I. So investors who should view this sector with a long-term lens, you should not only see that it deserves to be trading at a much higher multiple than what the market has assigned to it today, but it also merits inclusion as a core holding in any of your portfolios, given how important semiconductors are to the digital economy and by extension, the global economy. Now, so if you want to take advantage of this opportunity, you can of course do so using our recommended ETF, which is none other than the 𝗪𝘃 Semiconductor ETF. So this ETF invests in a basket of 25 listed US semiconductor companies. It employs a modified market cap weighting methodology, meaning that it favors not only the largest in terms of market cap, but also the most liquid companies within the industry. So top 10 holdings, it consists of many familiar names, such as the likes of NVIDIA, TSMC, Intel, AMD, so on and so forth. And I'd like to highlight that this particular ETF, it has been on our focus list since 2019, as it consistently ranks highly among all its peers in terms of our ETF methodology. So some of the things that we like about this ETF is its relatively low expense ratio of just 0.35%. And of course, its large trading volume of more than 8 million shares changing hands each day, which should also ensure that you as an investor, you are able to enter or exit positions with ease. So overall, I think the ETFs, they are a great way for investors to gain diversified exposure to various sectors and markets, especially if you don't have the time to monitor multiple stocks or if you are just not confident in your stock picking skills. So in addition to this ETF, I'd like to mention that there is also a UCITS version available of this ETF that is listed on the London Stock Exchange, which you can also trade on FSMOne today because we have also enabled LSE stocks and ETFs. So the reason I'm bringing this up is because over the past couple of months, there has been some concerns from some investors that of NVIDIA's concentration risk. So given how good NVIDIA has been performing this year, it's no surprise that its allocation within the ETF has actually risen to more than 20%. And at one point before its rebalancing in the month of March, I think its allocation went up to as much as 27%, which is a significant portion of a single ETF's assets. So a higher allocation to a single stock, it works two ways. On one hand, if the stock does well, then you as an investor, you stand to gain. But on the other hand, if the stock makes a loss, you also stand to make massive losses as well. So the UCITS ETF, it effectively mitigates this by placing a 10% cap on single stocks. So essentially, if you are concerned about concentration risk, then my suggestion is you go for the UCITS ETF. On the other hand, if you're comfortable with having a sizable exposure to NVIDIA, then my recommendation is to stick with the Nasdaq listed one. Okay, with that, ladies and gentlemen, this is my final slide already. So whenever I talk about semiconductors, I always like to end with this slide, simply because it sums up our investment thesis in the simplest way possible. So if there's one thing that you take away, it should be that without semiconductors, all the technology that we have today, your iPhones, your Facebook, Instagram, your Taobao, all these things, they won't exist. And if you believe that the world is going to become increasingly tech-driven, then the demand for semiconductors should become stronger as well. And with that, ladies and gentlemen, I end my sharing today. Before I leave, I'd like to wish all of you all the best in your investing journey, and I hope that all of you can make lots of money this year. Thank you for listening.